With savings rates what they are, some Aussies are thinking about alternatives to get more for their money. If you've saved up some cash and want to grow it, you've got a few options. There are many ways to invest, all with differing levels of return, risk, and accessibility. Here we will compare the benefits and drawbacks of stashing your cash in the share market, in your superannuation, and in your savings account. Let's start with the stock market. The stock market can give you huge returns if you're lucky enough to invest in the right stock. Think about Apple 15 years ago. But you can also lose big if you bet on a stock and the value plummets. A potentially less risky way to dip your toe in the water is investing in what are called exchange-traded funds, or ETFs. An ETF is a bundle of stocks and/or other securities, so if one drops and one gains in that bundle, your risk isn't as concentrated. But this doesn't mean ETFs don't have the potential to make huge returns. For example, the top performing one last year made about 68%, and that was after fees. Well, this is a major outlier. ETFs can generate nice returns with potentially less risk than buying just one stock. For a bit of context, in the past year, the average return delivered by all Australian listed ETFs was about 8%. But many of the top index funds sit around 12%. Now that you've learned a little bit about ETFs, here are some pros and cons. First, you have the potential to earn much more in interest than a savings account or even the average super fund. Second, it's accessible, so you can cash it in whenever you want. Third is control. You can pick the areas where you invest your money. Despite all the potential benefits, there are fees to buy into ETFs, and your money is never guaranteed. You can learn more about ETFs via the links in the description below. Now, superannuation. The best performing super funds over the last few years have returned about 10% a year, which is certainly a great return. And since you're looking at super as something you won't touch until you retire, it's good to look at the fund's long-term performance. Here are some positives of investing your money in super. Contributing extra money to your super is a great way to ensure you retire with enough money to fund your lifestyle when you're no longer working. Second, the magic of compounding. Your money will continue to grow until you retire. And third, the tax benefits. You could be eligible to claim a tax deduction for the money you personally contribute to your super. You could also lower your personal taxable income. And now some downsides for super. You can't access the money until you retire in most cases, so make sure it's not money that you'll need to use in the short term. And if you're in a standard balance or growth fund, which most Australians are, you don't have much say in how your money is invested. Last but not least, good old-fashioned savings accounts. Savings accounts are safe. Your deposit of up to $250,000 is guaranteed by the government. The money is accessible at a moment's notice, and you get better rates than many term deposits. On the flip side, drops in the cash rate have seen savings rates drop. The maximum return rates are much less than ETFs or super, and you do have to meet some ongoing deposit conditions to get the higher rates. So it's not a set it and forget it strategy. Really, it comes down to your financial goals. How much risk are you willing to take? Do you need to access your money all the time, or are you happy to let it grow untouched? ETFs typically achieve a much higher return than a standard savings account. However, you'll need to be comfortable taking on the risk. Super is potentially less risky than ETFs with decent returns, but it will be locked away until you retire. Savings accounts are the least risky option, but they offer less return. However, if you need the money in the next year or two for, say, a house deposit, it might be a better option. Keep in mind, it's not about choosing one over the other. Most investors would encourage a balanced approach that incorporates all three options. Whether you're considering investing in ETFs, savings accounts, or your super, we've got tons of information below to get started. Thanks for watching. Don't forget to like and subscribe for more videos just like this one.